The Bank of Canada risks falling behind. There is big dangers in the game that they are playing. So let's get right into it today, you guys. Let's take a look at the first article that we're going to be showing you. I believe that it was on Financial Post, and I want to look at the CPIs that we're dealing with as well. If we take a look at the CPI in Canada and the States, this is since 1940. Notice the bottom of the chart here. 1940, that goes into all these spikes, but notice that the two lines between Canada and the States are very, very, very similar. They're always tacking on right behind each other. This is important for us to know. Now, let's take a look at this Yahoo Finance article. It's talking about the Bank of Canada risks falling too far behind the Fed. So this is a big, big problem. Did you notice that chart though? The chart is showing CPI is very, very similar in the two countries. Now, this he is mentioning he's an economist for the Bank of Nova Scotia. The Bank of Canada is limited in how much its interest rate increases can lag behind those of the Federal Reserve. Notice again, we were very similar on the CPI, on the inflation numbers. So we have to have a similar response. But they're promising to pause their rates. But are they? I don't believe that they will. Now it says the gap is threatening to weaken its currency and fuel inflation. This is the worry because we're talking about things in prices going up and up and up, and we've had enough of it. We don't want it to go up anymore. Now, in Canada, inflation is still too hot. Inflation expectations are on the rise, and the weakening loony or the Canadian dollar is flashing warning signs. The magnitude of the policy rate deviation between the Federal Reserve in the US and the Bank of Canada relative to the differences in the macroeconomic circumstances make me concerned about the extent in which the Bank of Canada can fall behind the Fed. This is what we're talking about. And this has a lot of jargon in it, you guys. But basically, if a country has this much inflation, they need this much interest rate, right? So if one country has inflation this high and puts interest to match it, what happens in Canada if the inflation is this high, but they're like, nah, we're not going to raise it? That means inflation is going to continue to take off. Now, this is where the problem is because Canada and the United States are the number one trading partners with each other. We have the largest unarmed border in the world, very, very similar economies, and we have a lot of privileges because we are still within NAFTA. This is a relationship that's going to continue. And so we have to pay attention to some of the stuff that is out there just to give us an idea of where we are. This is the danger. If we look at the United States, the Canadian dollar over time, we can generally see here in the 80s, it was always sitting. What is the average in the 80s? Probably $1.30. It got a little bit better down here around the $1.20 range, but you notice it got way out of whack coming into 2002. But when there was that crash in 2007, did you notice right here it got to par? So for several years here, the Canadian dollar was bouncing around par. So I'm telling you right now, what happens if the Canadian dollar is worth the same as America? Well, all the Canadians will buy stuff in the US. When it's this way up here and our dollar is out of whack and it's not worth a lot in US dollars, Americans are sucking up everything they can from Canada. They're buying houses, cars, they're coming up here in droves to buy everything because their dollar goes so far. But that is in these two giant economies, even little stuff has a lot to do with it. If we look in the past year, it's been bouncing around, but that's because our interest rates have been similar. Now, the interest rates also have something to do with something called money supply. How many dollars are out there? And if we can see the US dollars going all the way back to the 60s, it's just climbing, climbing, climbing every year, one, two. And then after we get to 2007, it just starts going like crazy. So it's like a ski hill going up. Canada is no different, you guys. If we max out that chart, it's just going straight up. Okay, big danger on both those sides. But I find it interesting when we put it into stuff like gold. Do you notice right here, this gold price? I want you just to try to remember two numbers for me. Gold, US dollars, okay? So in 20 years, it made 400%. In 5 years, it made 40%, okay? And a couple reds. Now let's change this. 440, okay? Now we're going to change this to Canadian dollars and see the prices because we like 430. But look at this, 483 and 46. So the percentages changed. Remember before it was 3 reds and now there's only 1 red of a loss. This is my point, is we measure gold and silver, or something that is a solid item that hasn't changed in thousands of years. We're measuring that with a dollar that's continually devaluing, which is the issue. So looking at those interest rates is so important, and the trade difference. So let's play a game. If the Canadian dollar is at par, Canadians buy more stuff in the States. If the Canadian dollar loses value, then US buys everything from Canada. It turns, okay, inverse. But when interest rates go up in one country, that means that they think that the bonds will get more money, the treasuries will get more money, people have more faith in that dollar. So if the interest rates go up in the US and not in Canada, and Canada pauses rates, that makes the US dollar stronger and makes the Canadian dollar weaker. So what does that mean? We just gave that answer. That means America will come and buy up more stuff in Canada. Okay, so that's good for exports. But ask yourself, are you in an export country? Are you an export company? That's only good for them. But what happens to you who lives in Canada, who's importing everything? Everything you buy, from baby food and diapers or whatever else that is being imported from the US, prices got to go up because that dollar is worth more now. More inflation. And so the Bank of Canada is in a tough position. They want to bend to public policy and go, okay, guys, we're going to pause rates. We know we've done a lot. Guys, you spent too much money in 2020 and 2021. This is the bill that we have to pay, unfortunately. And it's not a popular one politically, but interest rates have to go up in lockstep with the US, or it's going to make inflation worse. So I know that it looks good on the TV saying we're going to pause rates and everyone feels good about that. But again, the prices of everything that you buy have to go up in response to that. And that is the big danger. The government is stuck between a rock and a hard place, unfortunately. How do you ever get out of this? There isn't really a good way to get out of it. Just imagine you're a family that makes $100,000 a year and you spend $200,000 a year. You have overspent. So you either have to pay it back with real money, or you got to go get another line of credit and then add to the problem. And that's what the governments have been doing now for over a decade. So there is no party in any Western democracy right now that will choose to actually give the message that the people need to hear. We need to have less services and more taxes in order to pay off the debts. No party will ever win on that platform. Nobody wants to hear it. Everybody just wants everything right now. Isn't that a crazy world that we live in? I think it's crazy, you guys. Anyway, wish you the best, guys. I'll talk to you soon. Please be careful out there. This information is critical. I always say the next 2 years of your life is going to dictate the next 2 decades. Stay safe.